I actually did this earlier with another student, so I'm just going to do it again because I know it works. That way we don't have a risk of me going off on a tangent. But I'm going to do Adobe. Some of you are doing Adobe, right? Ryan, you're doing Adobe, right? So you'll get to see me do Adobe. I'm going to do Adobe 2 ways. I gave y'all 3 ways to do a forecast. I'm just going to do 2 of those 3 ways because the third way is, I'm not sure it's mathematically a good way to do it. So I'm going to start with, you've got your Excel file, right? Y'all have your Excel file. It's got plenty of data in it. Let me just show you one thing to make sure you're aware of. On the paste values page, you have Adobe. You have Adobe at the top. And when you page down, you now have Autodesk or whatever your second company is. You page down, there's a section below that that says Adobe again. And the reason I did that is I wanted the years to go left to right. It was just a lot easier in Excel if the years go in the same order. And so you're probably, if you're going to be pulling data, you'll probably pull it from down here. And I'll show you what I mean by that. All right. So what I'm going to do is flip over to the forecast page. And I'm going to put a freeze frame in here so we can look at it. All right. So what I'm going to do with Adobe is I'm going to use revenue per employee as my link. So I'm going to bring in employees. Now, if you're doing property, plant, and equipment, you can do the exact same way. If you're doing square feet, you can do the same way. Whatever you're doing, just bring in that number. So I want to bring in that number. So I'm going to go over and do equal and go to the paste values. And remember, I don't want to use Adobe in row 1. I want to go down to the Adobe in 101. And then I'm going to find number of employees. There it is, row 117. So if you're doing property, plant, and equipment, it's not called property, plant, and equipment, so you have to actually find the actual account. It's on line 120, property, plant, and equipment. It's kind of hard to find some of them. If you're never sure, one thing you can do on print page 1, which is where I reference the numbers, you can go to print page 1 and see what row I'm referencing, and that can help you find it. But employees are on line 117. I'm going to copy that over. One thing I recommend when you copy, you do Control-C and go to the right. And I'd recommend that you paste it as formulas. Paste values, paste special formulas. Otherwise, these lines get in there and they mess it up. You don't have to, it's not that big of a deal, but I like to do that. So there's my employees. Now you'll notice I'm missing 2 years. I'm going to make those up. I'm going to make them up by taking, you shouldn't have this problem with property, plant, and equipment, but the employees you do. So if you're only missing 1 or 2 years, just average them in there. So all I'm going to do is I'm going to take last year plus the next year I have minus last year. And since there's 2 years there, I divide by 3. You see how that gives me a number? And then I can just take that year plus the previous year. You know, whoops. That year plus the difference that I just added. So you see how I got it. However you want to do it, you can do it just visually if you want to, if you don't get it precise. But I'm doing it so that it goes exactly equal distance. So I now have employees in there. All right, I have all my employee data. And boy, I'm working on 2 computers and I keep switching keyboards, which doesn't make sense. All right, so there's my employees. So I'm going to use revenue per employee. So that's pretty easy. I'll take revenue divided by employees. You need to take that and multiply by 1,000,000. And that gives you your revenue per employee. It should be in the few $100,000 range is the typical. I'm going to copy that over. So whatever I want to use, whether it's revenue per square feet, whether it's revenue per employee, revenue per property, plant, you want to get all that data in here so that you can work with your forecast. So here I've got my employees and I got my revenue per employees. All right. Any questions up to there? Now, the reason I'm pulling this from the PACE value, not from print page 1, is print page 1 only goes back 10 years, whereas the PACE values goes back to 2001. So you may have more data than shown on print page 1. The next thing I want to do is do growth. I want to do growth in employees, in growth in revenue per employee. So my growth in employees, I just take 1 year divided by the previous year minus 1. For my growth in revenue per employee, I just take the current year divided by the prior year minus 1. And that gives me my numbers. I'm going to copy that over. All right. So this is what I said. I'm not looking for a fancy forecast. If you did this in your first job, you'd probably get away with it, mainly because your forecast is going to look good. When they see how you did it, they're probably going to be a little upset. Say, wow, you can't do that. That's too simple. But at least you'd have a good, some decent looking charts. All right. So any questions up to there? So what these two green things here say is, if you're using these two things to forecast, then you want to forecast each one of them. What is employee growth? I'm going to move these down a row. I'm going to do Control X and move it down. So here's my forecast, or if you want to, move it up so it's on the same row here. So here's my growth in employees, and here's my growth in revenue per employee. And all I'm asking you to do is go back and look historically and to see what your numbers are. My growth in employees has averaged about 11%. So it's been pretty strong. It's been dropping off this last year, but I might say, okay, let's kind of bring them down over time to kind of a 5%. Oops. And here's where you have to write it in the paper. You have to justify this. So you got to tie back to what you said in paper 1, what you said in paper 3, what you said in paper 4. What's going on with this industry? I've seen some students actually pull a chart from paper 4 to help justify paper 5. Remember, the main key I said on revenue growth is their asset turnover improving? You know, what has been their revenue growth going forward? Those kind of things, but you have to have some justification. Now, for 2019 with Adobe, given what's going on with everything they're doing, is, you know, it's that 17%, I think, is pretty ridiculous. So I'm going to look at the years before that, and it's been growing about 6%. I don't think that's sustainable. Revenue per employee should really, over time, kind of grow in around the 2 to 3% range. So I'm going to do the same thing here, is I'm going to bring it down over time. And again, you have to justify this. So what you need to do is say how you built your forecast and then say how you did it. So it's going to be a combination of looking at the recent history, the longer term history, and what you said in paper 3 and paper 1 and 2. So what you said in papers 1, 2, and 3. Were you very confident with this industry? This is a growing, strong industry. Is this a company that has a good economic moat? You take those. It will not give you precise numbers, but I'm not looking for precise numbers. I'm looking for a justification for the general trend that you expect, okay? So I'm not asking for much. Once you put numbers in these two green boxes, it automatically updates your revenue up here. All right, any questions up to there? After you get your revenue forecast, that's half the paper. The rest of it's pretty simple. Here you really rely on history. So every time there's a green line, just look at it, and you look at them. Boy, it looks like 85 is a good forecast here. So I'm just going to use 85 for their gross margin. That's what they've done. So it looks pretty confident. I look pretty, I'm pretty confident on that. Here on the net margin, it had been up in the 60s and 70s, but the last few years it's been dropping down. So I'm going to let it keep dropping down to 55, 54, 54, 53. The trend is definitely down. And I think part of this is, I think the impact of the digital side. I think it actually has that kind of impact on them. But I don't know this company well enough. Ryan could explain it to us, so I'm not following them. Here you have miscellaneous items. Hopefully that's a small number. I'm just going to plug in a small number because it's a small number. Put that across. Then you get down to the interest on the debt. And you can see it's been pretty low here pretty recently. And we know interest rates fell a bunch this year. So I'm going to drop interest rate on debt down pretty low. Their debt's not that high, so it doesn't have that much of an impact. But we just know interest rates have really fallen this year with COVID-19. And even corporate spreads haven't gapped out that much, so I'm keeping that pretty low. Now, income tax expense, we know the rate is 21%. And if you think Biden's got a good chance of winning, he's talking about a 28% increase, so maybe you kick it back up to 28. What happened these 2 years? I don't know. But their previous years were more in line with the actual marginal tax rate for the US. So I'm going to take them back to that. When I do that, that's going to definitely have impacts on my my growth in earnings, because my growth in earnings is going to look a lot worse because I'm paying a whole lot more in taxes. If I use the 8% tax rate, my earnings would be huge. But since I'm using 21%, because they're not going to change the corporate tax rate for 2020, no matter who wins. They're not going to retroactively go back and change the rate. But let's just say they change it for 2021. That's possible. During 2021, they could actually change the rate and apply it to the entire year. Or maybe you say it takes some time or whatever. I mean, it's up to you to make some assumption there. So now we have an earnings per share chart. I don't think, Sabre, I built an earnings per share chart, but you could certainly build one of those, and I'll show y'all how to get the red. Here we have the CFO. CFO looks a lot smaller versus what it's been in the past, but that's because I haven't done the balance sheet yet, so there may not be a problem there. So keep going. Don't worry about that. We'll keep coming down. Any questions up to there? You see, all I'm doing is looking at history, making some assumptions. What do you need to talk about in your paper? Talk about the important stuff. Gross margin, net margin. No reason to talk about the miscellaneous. Probably no reason to talk about interest expense. You could if you wanted to, but don't talk about the small stuff. Talk about the big stuff. If you wanted to say you assume tax rates went back up, that'd be a good thing to put in the paper so that you're paying attention to what's going on. Then when you get to the balance sheet, again, you just look at history. So here's the accounts receivable. The accounts receivable have averaged about 14.5% over that time. I'm going to go back to that. Accounts receivable about 14.5% of revenue. That seems reasonable. I'm getting good numbers there. Inventory, they don't have inventory, so that's easy. Although I was surprised, I think I told Ryan that I was surprised that they didn't have inventory, but they don't have inventory. Goodwill, I usually on Goodwill just plug something close to the last number and just let it go. It's not that material, doesn't have that much of an impact on your financials, and just plug something in. You know, it's jumped up. I know they're going to amortize it over time, but it's still so unimportant. Just leave it there. Other assets, it's been running in the 40s, but for some reason, the last 2 years, it's dropped back down. There's a judgment call for you, whatever you want to do. I'm gonna keep it at where it was this last time. Their property, plant, and equipment is a really small part of their business, so you probably don't. If it's a big part of the business, you might need to talk about it. Small part of business, then just plug in something that looks that it's been 6% the last 4 years, so that's pretty constant. Their depreciation, I'm going to just split the difference there and use 45%. Their accounts payable as percentage of cost of goods sold, that looks pretty stable there. I'm just going to use 65 there across. Their debt to equity, their debt jumped up in 2018, but it looks like they're trying to bring it back down more into that normal 25 range. So I'm going to keep them doing that. I'm sorry, don't do that. 0.35, 0.3, 0.25, and then I'm just going to keep them at the 0.25. If their debt's pretty large, then you need to explain that. If their debt's not large, like if I were Ryan, I wouldn't even talk about the property, plant, and equipment forecast at all. I completely ignore it. I wouldn't talk about the goodwill forecast either. It's just not that important. Debt to equity, I would talk about that. I'm assuming after that large increase in debt in 2018 that comes back down to more normal levels. That gives me a net worth. Then dividends, they don't pay dividends, so that's pretty simple. Let's make that 0. Their stock buybacks, they've actually done some pretty hefty stock buybacks. I'm going to put that at 70% all the way across. Don't worry about this divide by 0. It's just they don't pay any dividends, so that's not an issue. And I'm done. I now have a forecast. If we go back up and look at CFO as percentage of investments, I mean, of earnings, it still looks a little off, but I can't explain why that's the case. There's some issue. But if you just look through, you can look through the items, make sure everything just seems to make sense. Nothing's like a major disconnect. Everything looks pretty reasonable. All right, and so then we get to the graphs. So the revenue forecast graph, they shot up and then it's starting to curve off. So I just kept that. It may still be an aggressive forecast, but I don't know this company the way Ryan does. So I'm just making up numbers here. The gross margin in dollars is probably going to follow the revenue. So I'm more interested in the gross margin as percent. And so I'm keeping it fairly flat. It was ridiculously high. Some of these tech companies, boy, they just cost them almost nothing to build a product. EBIT looks pretty reasonable. The EBIT margin looks pretty reasonable. It's coming up a little bit. Asset turnover is coming up after being flat for some time, but I'm just extending that. ATO times margin, obviously with margins up a little bit and ATO up strong. ATO times margins really strong. Return on equity looks good. All right, so let me do Saber's point. Let's say Saber wants to add earnings per share. So you go in and you find earnings per share. Go back into your forecast. Find earnings per share. Where is it? Line 50. So I'll plug that in, copy it across. So it's on line 10. So I'm going to come down here, take this graph right here, copy it, and paste it. And then I'm going to go in and just edit it and just change Series 1 to line 10. Be careful you don't use the arrows. You know how Bill Gates, when you use the arrows, he thinks you want to go somewhere. It's really irritating when he does that. Oh, wait. Cancel that, forget that, just a second. You do have to do 2 lines, I forgot about that. So you notice on revenue, it goes 2 lines. Gross margin goes 2 lines, so you actually have to do it 2 lines. So let's go back. I'm going to undo all of this just a second. So what you need to do is actually add 2 rows, or actually probably better. Yeah, let's add 2 rows. So insert 2 rows. Sorry about that. I forgot that I had to do that. You do earnings per share, and you go find that on line 10. Copy that across, all the way across. And then above that, you see how I have this? Here's the line all the way across, and right above it, I do it again. So just reference it for the forecast, and just do it again. So you need to have it in your 2 places. So we're on lines 11 and 12. So just remember that, lines 11 and 12. So now when I copy this one over and I edit it, select data, edit it, that's line 16. That's line 20. I don't know why it's 16 and 20. That doesn't make sense to me, but so the first one's going to be the lower, well, we'll see. We'll see if I can get this right. So the lower line, line 12. And the second one should be line 11. Let's see if I got it right. I haven't done this in a long time. We'll see. Might be a disaster. But you can click OK. So it looks like it worked. EPS forecast. So I don't know, Saber, if you were to follow all of that, but there's their earnings per share forecast. Looks a little aggressive to me. So you have to have 2 lines, and you want all the years on the lower line, and then the forecast on the upper line. And then just make sure when you edit it, series 1 should be the lower line and series 2 should be the higher line. If you do that, you'll get the graph to give you those colors. Okay. Was that enough, Saber, for what you were asking?
Yes, thank you.
All right. And you're on mute. I can't hear you, but okay. I think you said yes. All right. So questions on that. I'm going to do one other forecast, but questions on that. Now when I look at this, I'm getting a little nervous. Boy, that looks awfully aggressive. This is one I wish we had access to Bloomberg and you could actually go in there and see what the Bloomberg forecasts are. To get some sense of what. I haven't looked enough at Capital IQ to know if they have some earnings forecasts and revenue forecasts or not. They might. So you might be able to do something like that. But anyway, that gives you a forecast. So no questions up to there. So step 1, get that revenue forecast. Put a good justification somewhere in your paper. Talk about that, and then fill in all the other green stuff and talk about some of them, the most important ones, the ones that are the biggest dollar amounts, talk about them. The ones that aren't, leave them out, and create some graphs. I think some people are losing points on a paper because I didn't create a graph, so they didn't create a graph. Kind of the Sabres question. So there's no graphs anywhere on the balance sheet. So how do you talk about the balance sheet? So you might have to create some graphs yourself, but have some way to talk. The balance sheet is only 10% of the paper, but has some way to talk about it. How did you come up with your debt to equity? How did you come up with your accounts receivable? How did you come up with your accounts payable? Just explain those. I did my accounts payable as percentage of cost of goods sold. It's been running about 14% historically, so I assume that going forward. I mean, that gives you a lot of points on the balance sheet just by saying something as simple as that. Really, it's just saying the obvious sometimes. You can say, well, Professor Sweet, can't you figure this out? Well, but you're not writing this for me. You're writing this to put it on LinkedIn, so it needs to be well documented. All right, so I'm going to do a new forecast. So what I'm going to do is add a new page, a new sheet. I'm going to put it to the left of the forecast. I'm going to call it revenue forecast. I'm going to do a different type of revenue forecast, but I want to do it as its own sheet. All right. So if you're doing your own company, just add a page that says revenue forecast. And what I'm going to do is I'm going to go to the UTSA library databases. Y'all know how to get to the databases, UTSA library, hopefully. Everybody knows how to do that. And I'm trying to get, I'm not a Capital IQ person. I'm trying to learn it. I'm going to try to learn it really, really well in the next few months, especially over the winter break, because we're losing some of Capital IQ. What you're doing here online will not be available, so you need to get online and get your own account. But yeah, we were just talking in my careers in finance class yesterday with the people at Goldman Sachs, and they use Capital IQ a lot. I'm starting to hear it a lot more. Data and Tableau and SQL. I mean, we're just hearing the same stuff over and over again. So when you go on the Capital IQ, it always takes me a couple of times to log in for some reason. I don't know why. But, so what I'm going to do is up here, I'm going to look for Adobe. And click on it. Y'all tell me to stop if you need me to go more slowly. Just shout out. Trust me, if you're thinking that, someone else does too, so you'll make them really happy if you tell me to stop so you can catch up. All right, so find your company. You don't need to do Adobe, but find your company. So what I'm going to do is going to come down here to the segments, but look at all this information they have. And it's just, there's really some pretty impressive stuff here. But I'm going to click on segments and let that come up. Up here at the top, there's a little slider bar. I'm going to slide that. And Joseph keeps going out and coming in. I don't know if he's having technical problems or what. But slide that all the way to the side. You probably won't use all of it, but just bring in everything you can. All right. You can even tell just looking at this that it's pretty patchy in places, so we'll probably ignore a lot of that. And then I'm going to up here, it says download financials. I'm going to click on that, download it into Excel. When you download financials, it actually brings in more than just this sheet. So I don't know how many pages it brings in, but it'll bring in a bunch of pages. So that's kind of nice, right? All at once is kind of an advantage over Bloomberg, as it's already set up. The disadvantage of Bloomberg is trying to set it up so you can look at other companies, I think, but the lady in the library says it can do that. And so I'll have to be testing that. But you can see everything we have in here, income statement, balance sheet, all that, but we're on the segment page. So the other nice thing is when you say bring everything in, it brings everything in, but it keeps you on the page that you loaded, I think, unless it just happens to bring that last one in. So I'm going to take this entire sheet and I'm going to copy it, and I'm going to take it over to that blank sheet I just created. And here's one of the negatives on Capital IQ is that when they bring it over, it's a different color. And you can barely read anything. So I'm just going to get rid of that so I can read it. All right, so I now have Adobe segments all the way back to 1998. All right, anybody having luck doing that? Are y'all seeing that? I can see Saber typing around away. Anybody else having good luck with that? Are you able to find it, Saber? You're bringing it in? Okay. All right, good, Ryan. All right, so what I'm going to do is I'm looking at Adobe here, and the data doesn't really start the way I need it until 2010. All right. Now, the geographic goes back a little bit further, but there's a few years missing. But I think going back to 2010 is perfectly fine. I'm not going to do it. Well, I'll tell you what. Well, let's see. When does the geographic get in? Well, it all starts at the same time. So for some reason, yeah, I'm going to erase everything from 2007 and before. So I'm just going to get rid of those columns. Just delete them out of there. I won't be able to use it for this top section. Now, on this top section, you can see there's only really 3 lines. So I want to clean this up. So I'm going to get rid of everything that's not those 3 lines. We want revenue. So there's revenue. We don't need gross profit. So I'm going to take that out. So I'm going to get rid of all of that. And so what I'm left with, it's just digital media, digital experience, and publishing, because that adds up to their total revenue, those 3 things. It's not that they're not doing some of the other stuff, they just have classified it differently. So there's their revenue. The other thing I want to do is look at it from a country standpoint. You can see there, we just need these first few lines here. So I'm going to delete everything else that's not one of those lines. I don't need the assets. Just delete everything else. And then I'll get my total revenue. Right, so I got my revenue. I'm only going to use this top section, but I'm putting them both in there because you might prefer to do it geographically. So whatever I do up at the top with the business segment, you can do the exact same thing geographically. So you'll figure it out. It's the exact same process. Oh, sorry, just a second.
Pricing these products like
Sorry about that. I was recording for another class and it automatically started. Y'all don't want to listen to my life insurance class, so I'll turn that off. All right, so here what I want to do is I just want to kind of look at these numbers historically. And so what I want to do, let's look at the last 3 years, 5 years, and we can't do 10 years, so we'll do 9 year. Let's just look at the CAGRs. So how do you do a 3-year CAGR? Remember, you do the ending number divided by, and you go back 4 years. 1, 2, 3, 4. So you take that, make sure you put parentheses around it. y'all want this to be a little bit larger maybe here. So do open parentheses, the last year, if you're doing a 3-year CAGR, go back 4 years, raise that to the 1 divided by 3, in parentheses minus 1. So you want it to look just like that, and that will give you the 3-year growth rate, which is huge. And you can copy that down, and you can see these. Let me give us some freeze frames. So you can see that they're digital media and digital experience, and I'm not sure what those two things mean. I'm not a big Adobe, I use whatever Adobe gives me for free, but not sure what those mean. Publishing kind of makes sense. Publishing would be the weakest because people are not using paper as much anymore. Then I'm going to do the same thing for a 5-year. I'm going to do the last one divided by and then go 1, 2, 3, 4, 5, 6. Since I'm doing 5 years, go back 6 years. 1 divided by 5 minus 1. You can see a really hefty growth rate there. And copy that down. Publishing has grown the last 5 years, so it's really just the last 3 that they're down. And then same thing again for 9 years. You do current year divided by 1, 2, 3, 4, 5, 6, 7, 8, 9, which is, we have 10. We go back 10. So go back 10, raise it to 1 divided by 9 minus 1. And there's the growth rate there, not as much. And so we've got our CAGRs. So the question is your forecast. And it's the same thing we did before. You're going to give a forecast for each one of these. So you might say, we're going to go out 5 years here. 1, 2, 3, 4, 5. So you say, okay, well, boy, the digital media and the digital experience, digital media, man, they're still cooking. You can even look at, if you wanted to, look at each one on a year-by-year basis. If you want to see if the trend's coming down. So you can put that in there and say, okay, the trend was really high. It looks like it's coming down. So it looks like they're doing great, but I don't think they're going to be able to keep that up. So let's do 20%, 18, 16, 10, and then down to 6, something like that. I'm making numbers up. So Ryan, these won't be your assumptions. You'll do something far better than that. You can do the same thing with the next line and just see what's going on there. And here you notice a big jump last year. So that one, maybe you started higher. Since I don't really know the difference between experience and in media, I can't really tell you, but I'm gonna start them higher. Whatever. And on publishing, I'm gonna say, okay, that's a dying business. I'll shrink it down some. All right, so there I got my growth rate. So how do you get this into a forecast? Well, just bring it into a forecast. If you like to, you can, well, I'm going to leave it like this. So what do you do? How do you get 2020? Well, 2020 is going to be your 2019 revenue times 1 plus your growth rate for 2020. Your 2021 is going to be your 2020 times 1 plus your growth rate for 2021. And then you can just copy those over. And you can copy them down. And then your total revenues is just the sum of that. And in your paper, you just have to justify why you come up with these growth rates. And again, it goes back to papers 3, 4, 1, 2, and 3. So this is another way to do the revenue. So any questions on that? I don't know if I went too fast doing that. You can see how I'm not asking for greatness on these forecasts. You're really relying heavily on history, mainly because forecasting is really tough and you just don't have enough time to full-fledged forecast would be really, really tough to do. You need to have some basis, but it can be very, very subjective. It doesn't have to be mathematical. You don't need a mathematical formula to say, I got 20% by taking this times this plus this plus this. You just reference back, and in paper one, this is an industry that's moving. I see Adobe. Part of my picture, and Ryan could tell me if this is way, way off, but I see Adobe is really, really important with what's happening. There's a lot more the gig economy, much more franchising, freelancing going on out there. And that's spreading to Asia, Africa. But people in Asia, people in Africa, people in South America, they're going to want to deal with the United States because that's where the big media companies are. They're going to want to deal with the software package that is used in the US. So Adobe's going to have a huge advantage. And you look down below at their geographic growth, man, they're growing fast in Asia. And so that might be part of my justification is they still have a lot of room to grow the rest of the world. And they're going to have the advantage just because they're US based and the US is already a market they saturated. That saturation in the US, I think, would be an advantage as they move overseas because everybody wants to deal with the US when it comes to any type of publishing. So that's my argument. Now, that may be totally bogus because I really don't know this company that well, but I don't know this company well. So if you said that in your paper, you're probably gonna be okay because I don't have time. I'm not gonna go out and research how good your forecast is. And when you put this on LinkedIn, unless you interview with Adobe for a job, you're probably not gonna be in too much trouble. So I'm not asking for something that you're gonna be proud of 20 years from now as the best forecast you've ever done in your life. I'm really asking you to put something down that's rational and reasonable, and then justify it, find some way to justify it. So what I do now, I'm not hearing anyway, interrupt aggressive. So what I do now, go to the forecast page. What I do, pretty easy. And voila, I'm done. Whoops. Paste these formulas. This one's a much more aggressive forecast, isn't it? I mean, you look at my graphs.
Professor C, that would be only for the revenue section,
steeper
right?
Graph, it doesn't start trailing off there until the end. And then earnings per share is just going to be crazy steep, but it doesn't look radically different than that previous one. All right, so you see the two approaches here. The hard part is getting the revenue forecast. The easy part is getting all those other assumptions and just talking about them. All right, yeah, Victor.
I was just raising my hand. I know, Danielle, how did you go from the CAGRs? Because I got the 3 year, the 5, and the 10 year for my company, but how did you translate that into a figure for forecasted revenue?
Subjective. And it's the same way it is in business. Forecasting it's a really hard thing to do. If you do Exxon, someone was asking about this, you could run a regression of Exxon's revenue versus oil prices and natural gas prices and use that multi-regression. And you could apply it to your forecast. The only problem is now you have to do a forecast of oil prices and natural gas prices, which might be harder to forecast Exxon revenues. So it's subjective. It is the single most important part of your entire forecast, though. Anything you can glean from your other papers for what's reasonable. Now, some company is easy. If I was doing Campbell's soup, yeah, it's going to grow 2 or 3%. I mean, people aren't running out to buy soup. If I'm doing Walmart, it's not that difficult. They're such saturated. But a firm like Adobe, very subjective. You really got to pull back. And Ryan, you have some really, really wonderful analysis in your papers 1 through 3, stuff that you can really draw on that help justify that. And that's where the points come in, is how you justify your assumptions versus just saying, here's my revenues. Actually, trying to really, really put something that sounds strong, even though it may be pretty weak just because it's hard. This is really hard stuff. I'm saying you're not going to be doing great forecasts, but I'm not sure in practice the people in this business are doing really great forecasts either, especially 2 or 3 years out. Maybe next year they have some hope because management gives guidance. But I think forecasting is a really, really tough thing to do. And we know, looking at research historically, forecasts from the sell side are really pretty pathetic. So yours probably isn't any worse than anybody else's. So Victor, and to answer your question, this is the creative writing part of this class. You got to figure out some way to justify the numbers and make it sound intelligent, even though you may be just
For the capital IQ, that's just to forecast revenues, right? From there, we still have to do all the greens and all the green lines in
Yeah.
the other. Okay, all right.
Yeah, but there's not that many of them. There's only like 15, 20 lines. So yeah, I kept this pretty simple. I thought about building a cash from operations section or cash statement, but boy, there's no way for me to do that, and it works for every company. So I've let y'all just do CFO. You could graph CFO if you wanted to, but in real life, you actually do the financing and investing, and that's how you get your PP&E and you get your dividends and your stock buybacks. But I'm simplifying this quite a bit. I haven't seen this yet where it gives really bad forecasts. The numbers look pretty reasonable and use this approach, but it does have some definite flaws in it. But yeah, if you're having trouble, it really is just looking at the history and just now, Damaris, if you have something that's just all over the place, your best bet then is just take an average of the last 4 years and just plug that in going forward. That's probably your best bet.
And can I take the first year, like the first year for Lululemon, like 2001 till 2008, they have nothing. Like we can take that out of the graphs, right?
Yeah. That's one area where I think it's okay. You might try it and then, don't save it. I think you can actually highlight and just delete those. It will mess up your graphs because it's going to shrink them over, but they'll still be there. And you'll just have to stretch them out. You might move your graphs first before you do that, but I think you really can just delete. I'll even try it here. It's going to be kind of bad, but you move your graphs out of the way and then you just delete those. See how it fixes the graph automatically for you. So that works. Just don't have, because if you have the graphs there, see how it scrunches up your graph. So move all your graphs before you do that. But if you do that, you can just delete the unused columns.
Okay.
You definitely don't want zeros. You definitely don't want zeros down here. You want to get rid of those.
Mm-hmm. All right. Thank you.
Sure. All right, that's all I had. So it's a little early, but on a night like this, you're probably kind of distracted.